Welcome to Real Talk with Real Estate Pros, where we bring you exclusive interviews with the real estate experts. We'll delve deep into their journey to success and learn how to go the extra mile to serve their clients' wants and needs. Let's dive in. Here's your host, John Money McKinley.
Morning, everyone. Welcome to another edition of Real Talk with Real Estate Pros. I know I have been MIA for a little while here, but we are back. Just been working on a few things, getting things in line and adjusted. And I want to thank my producer in the back, Zach, for some more great bumper music to get the show started. Look in the comment section that you can give a thank you to the artists who have provided the bumper music for Real Talk with Real Estate Pros. There's a lot of stuff going on in the world of real estate, especially here in the Houston area. And there's a lot of questions going on in today's world about what's happening with the home values, as well as the big $1 million question, when are the interest rates going to come down? And I like to have on my special guest. He is a credit expert, and we typically have Mr. Greg West on the show once a month to really give us some insight as well from what's happening in the world of credit, because we've had some changes going on with that as well since last time I've been on the air. Mr. West, welcome to the show. How are you today, sir?
Glad to be back. How are you doing?
I am doing fantastic. I really appreciate you being here, sir. And I would like to ask everybody, this show is here to provide you all informative guests who are in the industry of real estate, credit, finances, to keep you guys up to speed on what's really happening in the world. You can turn on your television, you can turn on your newscasters, and at the end of the day, they're just actors on the screen. I bring experts here, professionals like Mr. West here, who is a credit expert. How long have you been helping people get their credit and finances in order, Mr. West?
Oh, at least it's 25 plus years. Yeah.
And I can attest, I've been working with Craig for just about all of those 25 plus years. And the things I've seen Mr. West do to help people out is phenomenal. But with that said, we're here to give you real information on what's happening in the world of real estate in your backyard. Look, we got to pay attention to what happens around the country with real estate, because that does have a little effect on us as well, too. But at the end of the day, you care about what's happening in your town. And please, I'd like to encourage everybody, go ahead and leave a comment, ask questions. We love answering questions for people. And if you know anybody who you think would be a great guest on the show, please shoot me up with a text up there. Let me know their name and number. I'd love to reach out to them. And as always, like, subscribe, and share. Well, Mr. West, why don't we dive into this? Because one of the big questions is, what's happening in the world of real estate today? And as we can see here, this is my backyard, Houston, Texas. It looks like the average home value has dropped 3.1% in the past year. We're starting to see a little bit of downward trend across the country. And of course, this is from Zillow. Please, if you want to know what the value of your home is and what the possible trending of it is, hire a professional expert to do an evaluation of what your current home value is. Greg, I know we were talking before you came on the air, and Greg is hiding in the mountain. I shouldn't say hiding, excuse me, in a secluded bunker so he can dig deep and get us all the credit insights in Kentucky. You said that was moving a little bit different in your part of the world, Greg.
Yeah, just for the heck of it, when you sent that, I put our zip code in, said we were up 5% from this time last year, which kind of doesn't surprise me. We're getting a lot of West Coasters in here buying the houses up quick. I mean, when they come up on the market, they're within a month, they're usually sold.
Wow, that quickly, huh?
Yeah, unfortunately, they're pricing out Kentuckians because our average income is one of the lower ones in the country. But yeah, that's what I'm noticing.
Well, that's something we've seen here, and at the end of the day, and let's take a look here. Let's go ahead and see what old Redfin is saying as well. Redfin is only saying that the Houston housing trends market value prices are down 1.7%. And at the end of the day, a lot of it has to do with location specifically as well too. We
Yeah,
are we are in all honesty, we are starting to see a trending downward across the country. And a lot of people forget back during the pandemic, there was a lot of unrealistic upward movement in real estate. Would you agree with that, Greg?
oh, for sure. A lot of everything was going up unrealistically. Yeah,
And you just can't survive that because you take away the affordability for people to be able to buy a home. Another trend that we've been seeing, and I've been talking with real estate experts in the area as well, is there's talk too that we're going to start seeing the rental prices continue to elevate, which is making it more and more difficult for people to find. And I hate the word affordable housing. However, when houses that were just 5, 6 years ago, where a good home was $250,000, and now that same home is $500,000, it's become unaffordable for a lot of Americans. Would you agree with that, Greg?
oh, 100%. I saw a chart somewhere. I wish I'd sent it to you at the time that the average age of first-time home ownership, I think, is in the 30s now for people before they
Yes,
get their first home. Yeah,
the average age in between the 30s and 40s right now.
yeah,
And I'm noticing that too, that I still do though. I am very grateful to say I do still have a good amount of first-time home buyers that are in their 20s, but what they're looking at, and this is something that I've noticed as well, at least in my part of the world, is a lot of them are looking at manufactured housing
yeah,
as an affordable alternative.
yeah. Those are nice homes. Yeah,
There's a lot that's changed in manufactured housing from what it was 30
back in
years
our
ago.
day, for sure. Yeah,
I remember back in the 90s, I mean, manufactured homes, I mean, they were trailers at the end of the day. You
yeah.
you go out and take a look at some of these homes now and it's like, wait a minute, this actually looks like a real home. And I've noticed
Hmm.
too that seems to be another trend for some people is they're as they're getting a little older, they're moving out more of the urban areas and moving more into the areas where they're getting a little bit of land and they're going, it just makes more affordable sense to go ahead and purchase a brand new double wide, get it set up the way I want it to get set up, the way the financing works and the way a lot of the setting up of manufactured homes works today is it is real property at the end of the day. So we're not trying to turn this into a sales pitch of manufactured housing. We're just talking about the different avenues of affordable housing.
Sure.
Another thing to look at here too is this is from HAR.com, Houston Association of Realtors. And they're telling us that Houston housing markets inventory surges and price adjusts. Inventories is off the chart. In July, we had 40,000 active listings, which is up 38.2% from a year ago. That's a substantial uptick.
Yeah.
Prices are softening. Single family homes grew 9.2% year over year, while the median price slipped to $339,000 and the average price to $434,000. More supplies means fewer bidding wars. Is this a good thing or is this a bad thing?
I guess it depends what side you're on. If you're a buyer, it's a good thing. You're a seller, not so good. There's always winners and losers. Everybody got to remember when any property, stock, anything changes hands, somebody's buying something, somebody's selling something. The money doesn't come out of just fly away, it just moves around.
Yeah, I mean, it's a double-edged sword.
Yeah.
I mean, and we're looking at it, and a lot of this, of course, is going to depend on my viewers and what their income range is. But look at the standpoint of the average price home in Houston area, $434,000. How many 20-something-year-olds can afford that?
How many that I know?
Yeah, I mean, it's and unfortunately, what's happened over the past 5+ years has put the reach of home ownership out of a lot of people's hands. Now, the good thing is if we do start seeing some more down ticking, as well as some softening of the market, that's going to allow more first-time home buyers to be able to purchase homes. We have a large generation that's coming up behind us. You know, the Gen Zers, the millennials, and unfortunately, our generation, Mr. West, the coolest generation ever, Gen X, is a smaller demographic. However, we've got to have something for the upcoming generations to be able to afford and have a good place that they can call home. And I'm hoping we see a lot more balancing out, as well as, and we're going to get into the interest rates here shortly, some alleviation of that. And let's talk about it, because I don't know if you're aware of this. Well, I know you are aware of this, Greg, but I don't know if my audience is aware of this. Is the nice folks are going to be chatting tomorrow, the wonderful Federal Reserve folks,
Mm-hmm.
who control all interest rates, right, Greg?
No.
Wait a minute, Greg.
A lot of people think so, but no.
Well, hold up, Greg. I hear all the time, when the Fed lowers the rate, that's when I'll look at buying a house, because that means my interest rates on mortgages are going to come down.
So a lot of people are told. A lot believe, but don't bother to look it up.
Something that I'd really, really like to share with people. And look, we'll talk about this right now. People are predicting between a 25 basis point and 50 basis point cut in the Fed's rate. Here's the thing to know about the Fed's rate. That is the short-term interest rate. That is the short-term money that businesses use for funds to run their businesses. That is the short-term interest rates between banks lending money overnight to each other. The effect that it has on the mortgage rates is usually insignificant. However, if we go back to just about a year ago, when the Fed did the huge rate cut of 1 basis point, which was a massive rate cut, what do you think happened with the long-term interest rates on things such as mortgages, Greg?
Well, truthfully, I wasn't paying attention back then, but I would say if that was the case, probably nothing.
Nope. Did the exact opposite.
Went up.
Oh, went up quite a bit. And here's something I would like to share with my viewers here. This is something that is very, very important. Is there something that you can always look at and go, I look at this and I know for sure this is exactly the way long-term interest rates are going to go? No. And I'm not here to try to get anybody to believe that. However, there are certain things that you can look at that are going to influence what happens with the long-term interest rates. We've seen a lot go on, especially over the past 5, 6 years, that has made 0 sense on why interest rates have gone down during the pandemic, for example.
Mm-hmm.
But what I've pulled up here, this is what's called the U.S. 10-year Treasury note. These are the bonds, the bond market. That's where people go for secure investments. And when money is pouring into the bond markets, the rate comes down. When this rate comes down, typically your interest rates will come down. Now, here's something to keep in mind. We have had a very, very attractive past little over a week now, where the 10-year Treasury dropped to roughly just below 4%, which has been fantastic for people wanting to buy homes or refinance homes. But keep this in mind. If the Fed lowers the rate, let's say half a basis point, and that causes businesses to really get some things moving, and that causes investors to get excited and start putting their money back in the stock market, what do you think's going to happen with the money that's sitting in the bond markets, Greg?
Usually sells off, which makes the rates go up.
Exactly.
Yeah, it's a conundrum. I think what's making them go down now is the constant revisions of the labor. I don't know how many people realize this, but it's almost been 1 million jobs have been erased with revisions. So when these labor statistics come out, they end up changing them months later under the radar where nobody sees it, usually to the downside. And so people are getting worried about the economy, so they're looking for safety. So they're buying more bonds, which ironically, the stock market's going up as well, which is odd, but different. It's like football. Everybody has different strategies when they're playing, just like, so money's the same way. But it looks like most of them are going into safety and high yield. Kind of the middle's kind of gone, I guess, at the moment.
I thought we weren't going to bring up football, Greg. We don't want to talk about football. The Texans are doing terrible. Oh, I'm sorry. Did I say that out loud, Greg? That was an embarrassment last night on Monday Night Football, but this is not a football show, so we will drop the football subject. But no, and something to just to keep in mind, when the economy's doing bad, it's great for interest rates. And there's no other way to put it, Greg.
Yeah.
Why did the 10-year Treasury drop over this past week and a little over a week? Because the jobs report stunk. Now, a lot of people forget for almost over 2 years now, the job market has always been revised and it's always turned out to be less than what we were told. The only difference now is the media is hammering that home. Is the job market doing great? No, not really. Really hasn't been doing all that great for past 2 years now.
No. And I can take just a personal from my clientele, how many of them lost their jobs recently. It's a pretty decent percentage, which of course makes me have less income and so on, et cetera. I spend less. So it's a domino effect for sure.
Yeah. And I know you and I have been talking about this for well over a year now, is you're kind of a canary in the coal mine, for lack of a better word, as far as kind of what's happening in the economy, because people will start to stop spending money on certain things first. And with your service as helping people with their credit, well, if they got a choice of continuing to work on their credit or feed their family, they're most likely going to go with the I'm going to feed my family option.
Yeah. And the other thing is a lot of them don't figure out they have a problem until they try to buy something and get denied. And if they're not interested in buying, they're not finding out that their credit matters. So it's two different reasons why. Yeah.
Exactly. Oh, and then there's one more thing here, back to what we were just talking about, and this is from Market Watch. Don't expect mortgage rates to fall after the Fed interest rate cuts. But here's one more move borrowers can make right now. And if they do cut the rates, you are really going to want to keep your eyes on what's happening with the 10-year Treasury and keep your eyes on what's happening with the stock market. It is a little abnormal, and thank you for pointing that out, Greg, that the stock market has been rising along with the 10-year Treasury coming down. That usually doesn't work that way.
No, which speaks to me, and I'm going to say this is not financial advice, but if you've got money in certain places, be on the lookout for blow-off tops here soon. You might want to start hedging, liquidating some stuff. Again, not financial advice, just keep an eye on your stuff. Because if it's anything like dot-com bubble, the great financial crisis 2008, it's going to be a significant pullback when it comes, because you can't have this continue like this. It's abnormal.
Yeah, this has been, and I've been in the real estate industry since the 90s. I've been in the mortgage industry since 1999 to date myself, but I've never seen a market like we've seen over the past 6 years, Greg.
Yeah, it's crazy.
And even during the heyday of the, subprime mortgages, when everything was going crazy and the banks were just Wall Street, I shouldn't say the banks, I should say Wall Street, because that's who it was really just feeding people with all the money they needed to buy real estate. We didn't see the appreciation that we've seen over the past 6 years on real estate, which should really tell folks a lot of what's going on. Well, let's dig in.
Probably has to do with those trillions of dollars created since COVID, I would say. But what do I know?
No.
Create more dollars. Out of nothing. But anyhow,
printing. Are you trying to tell us, Mr. West, that printing money? Wait a minute. I need to get clarity on this. Are you trying to tell me that printing money massively reduces the value of the said currency?
It does. So it takes more of that same currency to buy the same thing you bought, say, 1 year ago, 2 years ago, 3 years ago. Technically, that's what inflation is, but they tell you it's all kinds of other things. But yeah, it comes down to that because they don't want to take the blame for it. They being the ones that actually run it, which is the Fed.
The Feds.
Not the Gov.
The nice, wonderful folks who want nothing but our best interest at heart at the Federal Reserve.
Absolutely. They love us.
We love those people, and we should do exactly as they tell us, just like with the IRS.
Absolutely. Better do what they say.
Exactly.
You ain't winning that battle for those.
No. I tell everybody, if you've got debt and one of them has 3 letters, IRS, get rid of them first. Get them out of your life as quickly as possible for your best interest. Well, let's take a look at this here. This is President Trump's Home Buyers Privacy Protection Act, restricting mortgage trigger leads. This is something that is huge, and this is a great thing for a lot of people. And I'm going to give a brief explanation of what trigger leads are. If you've ever applied for credit cards or home financing, you have probably had your phone blow up with all kinds of wonderful telemarketers telling you that, they're going to give you the best mortgage deal, the best credit card deal, the best auto financing deal. And here's the reason why that is the credit reporting agencies own your credit reports. You do not own them. They are owned by the credit reporting agencies. And what they would do is there's lots of telemarketing companies, banks, mortgage brokers that will buy your information, credit score, other pertinent information about you, and contact information from the credit reporting agencies when you apply for a loan. Now, there is a way to do that. On my channel here, Real Talk with Real Estate Pros, there is a video that I have put together almost 2 years ago that shows you how to opt out and stop that. Well, with what Mr. Trump finally signed into law, this will stop them from being able to do this. But here's the catch, which I don't understand. It's signed into law. Why are they making everybody wait an additional 180 days?
I have no idea.
It makes zero sense. But
hurry up and wait.
Yeah.
Pretty much. Yeah.
Which always makes me question, is there a possibility that there'll be some bribing? I mean, bribing. How can I say that word? Lobbyists from the credit reporting agencies that may have some influence on some of the lawmakers to postpone this from taking effect.
No.
There is currently today massive amounts of money that is made off of them selling trigger leads.
Oh, I bet.
Have a good friend of mine in Michigan, and Michigan is a well-known, Detroit, Michigan to be exact, is well known for lots of mortgage companies being located and mortgage brokers being located. And there are multiple shops up there where that's all they do. They get all their business by hiring a bunch of telemarketers to get on the phone and pound phones and annoy you because you applied for a mortgage. I'll put the link to the opt-out video that I created so you can go opt out. And when you do that, you tell the credit reporting agencies that they can't sell your information. I strongly recommend you do that because 180 days is a long time from now. You don't have to be applying for a mortgage today or any other credit today, but there's no reason the credit reporting agencies should be able to sell your information like that. That's absolutely insane.
It is. And I recently added, and I'll give the website later, to my website, I put a link to the Do Not Call registry as well to get people onto that.
Perfect. Thank you very much. Now, here is, we're going to dig a little more into the credit side of things, and you brought this up to me as well, Greg. Americans warned of major credit score changes this fall. Ooh. Imminent credit changes to the credit scoring system in the U.S. could see millions of scores decline in the coming months. Uh-oh. Earlier this year, the scoring giant FICO announced that it would be incorporating buy now, pay later loan data into calculations beginning this fall, a move it said reflected the growing importance of buy now, pay later loans in the U.S. credit ecosystem. Please dive into this, Greg, because this is an important topic here.
Well, it's hugely important. And we talked about it months ago, but I thought it was worth looking at again because I was shocked at the number of, I think it said 90-some million people use those. That's like a third of the population, isn't it?
Yeah.
I was shocked the amount of people that use those things. It's like a firm and all these things where you see buy now, pay later, breaking in 3, 4, 5 months worth of payments. And a lot of people are managing multiple accounts. So when those start popping up on your credit reports, it's going to hurt several ways. One, debt to income ratio, which John will attest, that's hugely important buying a mortgage. And I know some people personally that haven't paid some of these things back. Didn't matter then, matters now. If you like miss a 30-day late or something. So if you're using these loans, you got to keep track of them, make sure you stay on top of them. Because you can have a perfect score for years, and 1 30-day late can just crush you. You can lose 50 to 100 points overnight. Because it's what happens recently that has more damaging than some of the old stuff.
That and a lot of these are short-term loans.
Yeah.
That's the other thing that damages.
They're not helping your credit if you're getting them for that reason. There's much better ways to build your credit history.
Another thing people don't realize is This is coming out of your checking account or whatever account you set up with it. Well, guess what happens when we review your loan for your ability to finance a loan? We're looking at the bank statements. We're looking at consistent withdrawals to one particular company that may or may not be showing up on your credit report. And this is years ago. This started really about a year and a half, 2 years ago, really started causing some challenges for people for qualifying. Everything looks good on the DTI and based on what we have. And then when they go out and find a home and they finally send the documents that are needed. Oh, we got a challenge here. You have a $600 a month payment to whatever. A firm. I'll just use that for example. Well, there's only 8 months left. It doesn't matter. We have to now take that out of your income, and now you do not qualify for that home anymore.
Yeah.
This goes back to, if you are looking at purchasing a home, it behooves you to really make sure that you have been fully approved and fully qualified. You've sat down with a loan officer who's going to take the time to review all of your necessary documents. I understand. It's a pain in the butt. Well, nobody's arguing that. However, you have to provide that information eventually. Let's get the hard part out of the way first. Let's get these documents taken care of first, reviewed, so when you're going out looking for a home, there are no questions if you're going to qualify or not qualify. It really, really behooves you to do that.
Yeah, absolutely.
Yeah, let's go on to this other one, Liberty Street Economics. Credit score impacts from past due student loan payments. Oh, Greg, please, let's dive deep into this.
The main reason I wanted to get into this is I've been coming across more and more reports from different sources, and like they'll have me, say a mortgage guy or whatever will send me something to look at. Why isn't the person getting approved? Credit's perfect, except, and then they'll have some 30, 60, 90-day lates on some of these student loans. And almost in every single case, the person didn't even know. What happened was during the pandemic, they stopped all these payments with all this stuff. So, of course, everybody thought, ooh, I don't have to pay these back. Well, you do. And it started, I think, in February or March. And these companies have been horrible at letting people know that, hey, you need to start making payments again. So they've just been slapping late payments on their credit. A lot of people don't even know because people are so busy. I mean, granted, it is an excuse. I didn't know, but a lot of them, they're not notified, especially if they came through text or email or something. They don't hardly send letters anymore with anything. So it can end up in spam. So if you've got student loans, you need to be proactive and contact these guys because you're not getting out of them. You can't even file bankruptcy on those things in most cases. So you need to stay on top of it.
And thank you for saying all of that, Greg, because that's very important. These companies have been horrible at letting people know. Yeah. And look, I don't want to turn this into a political show either. However, for the 4-year period, we heard you're not going to have to pay your student loans. Not going to have to pay your student loans. And people didn't have to pay their student loans. So it was a double conundrum. You had the television telling you don't have to pay your student loans. You had the government telling you you're not going to have to pay your student loans. And then as soon as that didn't go through, which Greg, you and I have talked about this before on my show.
Yeah.
We knew that wasn't going through. It was not going to happen. And good people got hurt. I have a client that I just helped this poor woman be able to buy her new home. And it was a new construction home. The builder's lender couldn't do it. And one of the reasons is she got hit by the exact same thing. Here's the sad part. As soon as she found out that there was a problem with it, she immediately brought the loan current. But guess what it gave her? 60 and 90-day lates.
Yeah. And usually the payments are like 30, 40, $50. It's nothing absurd. They just didn't know.
Mm-hmm.
Yeah.
This poor woman almost lost her home because of this, and she was in the 700s before. Luckily, her real estate agent and I have worked together before, and he said, you need to go to John Money McKinley. He can help you. If anybody can help you, he can help you get your home. And it's really unfortunate, but there's a lot of folks out there who have been hurt by this, and especially with a 90-day late, it just kills you. And it took this poor woman's credit scores down below 600.
Yeah. That's what I said, 50 to 100 points overnight. That's how it works.
Yeah.
And you don't get it back right away when you get a current either.
No. The credit reporting agency always takes quite some time to get you back up to standards where you should be.
Mm-hmm.
Well, oops, what is this here? Bear with me, Greg. Oops, this is not doing what, there we go, oops. Okay, The Guardian. Oh, Elizabeth Warren bill to ban employers from running credit reports in hiring. Huh. As the U.S. labor market comes under pressure, two senior figures in Washington are pushing to end practice that provides large swaths of U.S. work end practices that prevents large swaths of U.S. workers from obtaining jobs. A bill reintroduced today by Elizabeth Warren, the senator from Massachusetts, and Steve Cohen, the representative from Tennessee, bans employers from using credit checks to vet potential hires. Let me ask you a question, Greg. My job as a mortgage lender is to help people finance one of the biggest investments in their life. Do you think I should be able to have bad credit and not be financially responsible, yet be able to give people financial advice on one of the largest investments of their life?
Probably not.
Because right now, we currently have to have a certain credit standard to be a licensed loan officer or a licensed mortgage broker / banker.
Mm-hmm.
As much as I dislike the credit reporting agencies, I have no problem with that. Because that's kind of the same analogy as, hey, Greg, I'm going to go get into shape, and you ought to see this guy I found to help me get in shape. What's he like, John? Well, he weighs about 275, and he's usually chomping on a Big Mac when he shows up to train me. I mean, is that the type of fitness expert you want to go to?
No. You can take the bill either way. A good example, what you said would be positive, but as far as if it's a job that has nothing to do with financial advice, but most likely she has, I forget what percentage of bills she has passed. It's very few. So it's probably not coming to fruition, but I thought it was interesting because I deal with people that sometimes have to have good credit to get certain jobs. And also it's even impacting car insurance rates, which is weird. So I'm not a big fan of credit controlling your entire life, but there are certain aspects where it has to be. It's probably a good idea to be in place. I just thought it was interesting. It was Elizabeth Warren doing it.
Yeah, look, you're right. There's certain jobs that your credit is irrelevant on things, but there's certain jobs that your credit is. If you're going to be in the financial markets, the banking industry, the lending industry like myself, then you should be expected to have good credit.
I've even had examples with security, military, getting higher ranks and whatnot. I guess because they might get blackmailed if they have bad debts out there or whatever, but might take a bribe a little easier, things like that.
Well, it puts you in a weaker position.
Yeah, exactly.
If you're in a massive amount of debt and you've got credit challenges, and the opportunity comes along where somebody like those lobbyists comes knocking on your door. Oh, I'm sorry. Oh, wait a minute. That's right. This bill would not apply to congressmen or senators, right?
I think it would. I think it would be a good bill if it had some good exceptions in there.
Oh,
But,
okay. Yeah.
But odds are it's not coming to fruition anyway. I think her history of bills passing is slim. It's like near zero.
Well, that is a good plus on that. Well, with that said, Mr. West, it is always a pleasure having you on the show today. I think we've really given people a lot of good information here. I'll go ahead and put the link I'll pin it in the first comment for the opt-out credit report, so you all can do that. I'm going to strongly recommend you do that. Greg, if people want to talk with you and get a free consultation on where they're at with their credit standing, speaking of credit, as we wrap the show up, how can they get a hold of you, Greg?
Easily. You can call me directly, 859-625-4546. Or go to my website, westcreditservices.com, and you can schedule an appointment from there, whatever day and time you want.
Perfect. Well, I'm going to put you back in the green room, Greg. Thank you for being on. I'm going to say goodbye to the audience. And once again, this has been another edition of Real Talk with Real Estate Pros. I want to thank you all for being here. And please do me a favor, like, subscribe, and share. We're really, really trying to grow this show and bring this as a place where you can come to get some real, truthful information about what's happening in the world of real estate, finances, credit, mortgages. You guys have a great day, and we will definitely see you next week.